All right, I'm Jim Ingersoll. I want to welcome you to learning about subject to investing and how you can buy houses without needing great credit, how you can buy houses without needing money in your checking account, and banks to write you a mortgage. Isn't that great news? I love sharing great news with you guys all the way through all this training I've done with JP. Now, what is subject to investing? What does subject to mean? It means that you're going to buy a house subject to or with a condition, think of subject to like a condition of something happening. Now, anytime you buy a house, you gain possession and ownership of that house by what's called the deed. Now, by now, you guys know that the deed conveys ownership of real estate from one owner to a new owner. So when the person who sells you the house signs the deed and it goes into your name and gets recorded at the courthouse, you're now the official owner. It's that simple. But what happens with subject to investing is that the existing mortgage stays in place. So normally when you buy a house, say this blue house right here that I own in Chesterfield, Virginia, if you were going to buy that house, when you go to buy it, to get clear title, all of the existing loans, all the existing liens get paid off at closing, okay? But in this case, when you buy it subject to, the subject to means you're going to buy it subject to the existing mortgage staying in place. So you're going to buy it with a condition that the first position mortgage, in this case, is going to stay in place, and you're going to do that so that you can take over the payments for the seller. So you're going to begin to make their payments. So if you're buying this blue house, and the payment to the bank is $975 a month, and the loan balance when you buy it is say $110,000. Then instead of that $110,000 mortgage getting paid off at closing, we're going to leave it in place, and then as the new owner, you're going to start to send in that $975 a month. Okay, so you didn't need to go qualify for a new mortgage. You didn't have to do credit applications and credit checks and asset checks and things like that. You're essentially taking over the payments for the person selling you the house. Now, let me just refresh your memory on what a deed of trust is or what a mortgage is, depending on which state you're in. A mortgage or a deed of trust is simply a lien on title. Okay, so when they go to do the title search on this house, when you buy it, they're going to come up and say, okay, there's a $110,000 mortgage to Wells Fargo. And that deed of trust or that mortgage secures the note holder's interest in the property. Is like the glue that holds everything together. Okay, so there's a lien on title and they found it at closing, but the key is you're going to buy the house and leave that lien on title and start to make the payments on behalf of the person you're buying from. So you're going to get the deed. The person's going to sell you the house, sign the deed, give you the ownership. Congratulations, you now own this 3-bedroom, 2-bath house. The mortgage or deed of trust lien is not going to get paid off, and you're going to make the acquisition subject to the existing mortgage staying in place after closing. Wow, what a cool idea is that, huh? Basically, you're using other people's mortgages to make the acquisition. And that is a great way to buy. When you find the right house where it's got a good amount of equity and a great interest rate, it can be a really good acquisition for you. What's really cool is there's 7 good reasons that you want to do this. And I'm going to go through each of these 7, so write them down with me. First of all, it doesn't matter how much money you make every year. It doesn't matter how many houses you own. It doesn't matter if your credit score is a 475 or a 775. You don't need a big down payment, like if you're going to go buy investment property, it'd be 20%. And you get great interest rates because owner-occupieds get way better interest rates than real estate investors. When you go to get a real estate investor loan, once you own so many houses, the rates go up to 6 or 7%. You can probably find sellers who have houses in the 4% range right now that you can pick up those loans, and it's a great way to do. Now, some other reasons: personal guarantee. These will be non-recourse loans. You're not going to be personally liable for them. That's good for you as a real estate investor, but it also means you've got a huge responsibility to the seller of the house, because if you stop making their payments, they're going to get a foreclosure on their credit report, not you. Now, there's also no appraisal, so there's no junk fees, very limited closing costs. So you don't have to pay somebody $500 to go do the value of the house. And you don't have all these junk fees. Those have already been paid by the person selling you the house. What's really cool is you can really build a large portfolio of houses this way. A really good friend of mine in Colorado has done over 100 of these. So he's got 100 houses in his rental portfolio. All of them were done subject to the existing mortgage staying in place. So he took over payments for 100 people. You can imagine how much all those mortgages cost him every month. But the good news is he's got tenants in all those 100 houses, and he's creating a lot of wealth doing it this way. So 7 good reasons to buy them. First, you don't need great credit. You don't need income, no down payment. You take over the payment, so you get really good interest rates. No personal guarantee. You're not personally liable. Very limited closing costs because there's no appraisal and junk fees. So everything sounds great. Isn't that a rosy picture I just painted for you? Go out and buy as many houses as you want, taking over other people's mortgages. What can go wrong? There's a few things that can go wrong. Now, you're not going to get thrown in jail for this, but you do need to be aware of what they call the due on sale clause. Every loan is full recourse, and as part of that recourse loan that they've got with the person selling you the house, embedded into that deed of trust or mortgage is what's called a due on sale clause. And it basically says that if title is transferred, it gives the bank the right to call the balance of the entire mortgage due and payable right now. Right now. So is it illegal to buy a house subject to? Well, no, it's not illegal. By the way, this due on sale clause extends to other things. If the person were to do say a 3-year lease option to somebody instead of selling it to you subject to, that also could invoke the due on sale clause. If they were to sell it on a land contract or a contract for deed, that too could cause the due on sale clause to be called by the bank. Now, the likelihood of the bank actually calling the loan due when it's a performing asset for them is very slim. It's very unlikely to happen unless our interest rates start going up dramatically. Say you've got a 3% mortgage on this house, and suddenly interest rates nationwide jump to 8 or 10%. Well, the bank's losing a lot of money on your 3% loan when they could be making a 10% loan. That's the kind of thing you've got to kind of watch for. But as long as you execute the strategy correctly and you make everybody aware and sign some disclosures, you're not going to likely have them call the loan due, even though they have the right to. It doesn't say that they're going to do it. It just says they have the right to call the loan due. And you need to be aware of it as the investor, but you also need to make the seller aware of it as well, so there's no misunderstandings later. What else could go wrong? Now, you take over the payment. You now own this house, and you're responsible for making that $975 a month payment. If you're late, or if you decide to just stop making the payment, you're not going to be personally liable as the real estate investor, but your seller is going to be liable. It's going to hit their credit. It's going to hit their credit report if you allow the house to go into foreclosure. Again, it's not illegal, but they do have the right to come back and sue you for doing that. And if you do it a lot of times, they call it equity skimming. If you were to go out and do this, say 30 times and not pay any of them, you could get into what's called equity skimming, and you don't want to go there because you can get in a lot of trouble. Now, the other thing you need to be aware of, when your seller sells their house to you subject to the existing mortgage staying in place, they're not easily going to be able to go out and get another mortgage, because on their credit report, this is going to show as a liability with payments going out every month. Okay, so they're not going to easily be able to go get another mortgage. They're probably going to have to go rent for a while, and in most cases, they don't really care. Now, as the investor, there's a couple things you need to be aware of as well. The first is to avoid high interest rates. Right now, you should be able to buy houses subject to the existing mortgage with rates below 5%. That's great news. Don't get sucked into circumstances where it appears they have some equity and they might be at 8 or 9%, for instance. Don't get sucked into circumstances where there's a great interest rate at, say, 3% or 4 or 4.5%, but the house is upside down. and they owe 50,000 more than that house is worth. Don't get sucked into things buying houses subject to that have adjustable rates, because rates can go up. They can go down and they can go up. So if you avoid high rates, you avoid upside down houses, and you avoid adjustable rate loans, you're going to do just fine. Oh, finally, always check title prior to closing. Make sure there aren't additional liens. If you're buying a house from somebody and you're going to take over the mortgage and they're behind in their payment, you're going to have to catch that payment up, by the way, too. There's a possibility that other creditors have put liens onto that house. And you got to check title and make sure that there are no other creditors so that you get surprised down the road. But if you do things right, you disclose to the seller that there is a due on sale clause and that you're responsible and you make payments, and you avoid houses with high interest rates, upside down or adjustable rates. Double check your title before closing. Get the deed, and that's a great house for you to put into your rental portfolio, or maybe fix it up a little bit and resell it if there is quite a bit of equity. I'm Jim Ingersoll. That's the introduction to buying houses subject to the existing financing staying in place. I hope you enjoyed it. We can continue the discussion right in the forum.